They told you nothing changed. They told you it was just noise on a weekend. They told you the market would open on Monday and everything would be back to normal. That story died overnight. The United States has begun major combat operations against Iran. Not a tweet, not a warning, not another strongly worded statement. Airstrikes, retaliation. Multiple countries pulled into the blast radius. And while you were asleep, the price of real metal snapped awake. Here's the event, clean and fast. US and Israeli forces launched strikes inside Iran, reportedly near central government targets. The response was ballistic missiles aimed at US positions across the Gulf. Airspace shut down in multiple states. Shipping risks spiked near the world's most important oil choke point. Officials signaled the strikes aren't a one-hour episode. They're framing this as days, possibly longer. That is what happened. Now here's the part the mainstream always misses. War doesn't just move headlines. War rewrites settlement systems. It changes what people will accept as payment. And right now the market is screaming one message. Paper is cheap, physical is scarce. Welcome back. I'm your host, and this channel is where we translate chaos into positioning. No hype, no worship, just the signal hiding inside the noise. If you want to understand why gold jumped, why silver ripped, and why digital gold face-planted while actual gold printed a premium the size of a mortgage, stay with me. Because the next 48 hours are going to expose who was hedged and who was pretending. Let's walk through the chain reaction. First, the war language shifted. You can argue about politics all day, but markets don't trade opinions. They trade probabilities. And the probability of escalation increased sharply when leaders began talking in the vocabulary of annihilation, obliteration, casualties, and regime change. That's not diplomacy. That's a timetable. Iran's retaliation was not symbolic. Reports described ballistic missile activity directed toward U.S. bases in Bahrain, Qatar, the UAE region, Kuwait, and Saudi Arabia. Multiple locations, one message. This is regional now. Israel also faced retaliation. Gulf airspace closures followed, and the Houthis signaled Red Sea pressure again. Meanwhile, some major oil shipping decisions shifted as companies assessed risk around the Strait of Hormuz. This is how stress spreads, not in one line, but in a web. Now watch what the metals did while paper markets were closed. PAXG, tokenized gold, spiked to around $5,600 per ounce at the peak, roughly a 6% jump from Friday levels, before easing back near the mid-$5,400. That matters because it's price discovery on rails that don't sleep. It's not COMEX. It's not a press conference. It's a live vote from people who wanted exposure right now, not Monday morning. At the same time, physical quotes tied to China's market were described around 1,226 yuan per gram, translating to roughly $5,560 per ounce. Compare that to Western spot around $5,278 in the script's reference point. That's about a $282 premium. Read that again, $282. That is not a rounding error. That is a border wall between physical demand and paper pricing. And then you got the third tell. A major dealer in Thailand reportedly halted gold trading entirely due to volatility. People hear that and shrug. Don't shrug. When a large dealer pauses, it means the spread is moving faster than their ability to quote without getting run over. It means liquidity didn't increase. It disappeared. Physical and paper are not in the same universe anymore. Now zoom to silver. Silver traded around the mid-$95 area in the script's feed, with other references placing Shanghai spot above $100 and futures higher still. Western spot was referenced in the low 90s, creating a wide gap, roughly a $12 difference between physical East and paper West. That's the story, not silver is up. The story is, physical is pricing a different reality than paper. And then Bitcoin did what it always does when the room catches fire. It dropped hard, down toward the low $60,000 area in the script, triggering a wave of liquidations in leveraged longs in minutes. That's not moral judgment. That's market plumbing. Crypto is liquid. It's a button. When shock hits, people sell what they can, not what they should. So on the same weekend, digital gold sold off. Physical gold printed a massive premium. Silver held elevated levels with widening regional pricing gaps. That is the market telling you what it trusts when the lights flicker. Now, the most important part. The positioning signals were already flashing before the strikes. You saw it in the structure. COMEX registered silver reportedly rose by about 2.3 million ounces, while eligible fell around 2.6 million. Total COMEX silver was referenced near 360.3 million ounces. Open interest on silver futures reportedly dropped hard, down from roughly 162,000 contracts a month earlier to about 118,000. That's about a 27% collapse, while price climbed from the 80s to the mid-90s. Think about what that means. In a normal paper-driven rally, open interest expands. New contracts get written, more paper claims chase the move. Here, the opposite happened. Price up, paper participation down. That's not a meme rally. That's fear of paper exposure. That's players stepping away from the casino table. Then you had the calendar tell. The front month outperformed the later month for multiple days. That's a stress signal. That's, I want metal sooner, not later. Lease rates were cited rising for 6 days. The swap positioning mentioned turning deeply negative in the script. These are not headline indicators. These are internal temperature gauges. They measure the cost of getting your hands on actual metal, not the cost of betting on a chart. And then came the most absurd data point in the script. A report of a large recycler in Shenzhen offering around $15 per ounce premium for 99.99 silver, payment for delivery certainty. When recyclers pay up, it's not because they love you. It's because downstream demand is screaming and supply is not cooperating. So here's the sequence. The market structure tightened first, then the geopolitical spark hit, then the premiums widened in real time. Markets lead, headlines follow, always. Now let's address the objection before it becomes your mistake. Yes, but markets are closed. They'll gap and then fill. They always do this. Sometimes, not always. The key question is not whether futures gap. They will. The question is whether the paper market can bully physical back into obedience. Because there are two ways a premium collapses. Paper rises to meet physical, or physical stops bidding. Which one happens depends on fear, supply, and time is the villain here. Officials were described signaling strikes continue for days, not hours. Iran's messaging in the script was, no red lines. Regional bases were hit, airspace closures spread, shipping hesitation grew, the Houthis re-entered the chat, and both sides' rhetoric leaned toward regime endgame language. That is not a one-candle story, that's a series. So when Western markets open, you're going to see a gap. But here's the cliffhanger. Is the gap the beginning or the bait? Because banks have played this game before. They allow a spike, they let retail chase, then they slam paper to manufacture a failure. They try to reassert control by forcing weak hands to puke. But the physical market doesn't puke on command. If you're in Asia paying $282 over paper for gold, you're not selling because a futures trader hits a sell button in New York. You're buying because you don't trust promises. That's the war premium. Not for war itself, but for settlement risk. Now let's connect the dots that most people refuse to connect. Gold and silver sit on the fault line of two earthquakes at once. Earthquake 1. Geopolitics. War spikes oil risk, shipping risk, airspace risk, and sanctions risk. Earthquake 2. Monetary credibility. When conflict rises, the weaponization of finance rises with it. Freezing assets, restricting trade, pressuring allies, scrambling reserves. That pushes countries and institutions to diversify settlement assets. The more chaotic the map gets, the less comfortable people feel holding purely someone else's liability. Gold benefits from both earthquakes simultaneously. Silver is the weirder one, because it's half monetary hedge and half industrial lifeblood. It can get pulled in both directions. It can whip, it can scare you. But when you see lease rates climbing and physical premiums widening, that's the industrial side telling you, I don't care about your chart, I need metal. Now here's the part that should make you sit up. Most portfolios, according to the script's framing, sit around 1% to 2% gold allocation. That's not a conspiracy, that's a habit. People treat gold like an accessory, something you add when you're already scared. But the market is acting like gold is not an accessory. It's acting like gold is an escape hatch. So if physical is trading nearly $300 over paper in the biggest buying region, what happens if the average allocation goes from 2% to 4%? It doesn't double demand, it detonates demand. Because metals markets are small compared to global capital pools. They don't need everyone to believe. They just need a tiny percentage of big money to re-weight. That's how you get vertical moves that look impossible, right up until they happen. Now let's talk about the digital gold narrative, because this weekend gave you a live stress test. Bitcoin dropped sharply during the shock. Again, that doesn't make it dead. It makes it what it is, a high liquidity risk asset that people sell when they need cash fast. Gold did the opposite, especially in physical markets. So ask yourself one blunt question. In a true geopolitical escalation, which asset becomes collateral and which asset becomes refuge? That's not ideology, that's behavior. Now the script referenced something else that matters. ETF holdings were described elevated, central bank buying was part of the broader narrative, and the silver market had been printing a streak of green months. Whether you agree with every detail isn't the point. The point is the setup. Sustained demand with visible strain, then a geopolitical catalyst. That combination creates the kind of price action that breaks people psychologically. It creates whipsaws that make you overtrade. It makes you chase tops and sell bottoms. And that's exactly what paper traders want. Confusion is their weapon. So here's the playbook for the next 48 hours, not as financial advice, but as survival advice. 1. Watch duration. Not just did something happen, but is it continuing? If strikes expand or persist, the premium logic stays alive. If it de-escalates quickly, paper will attempt to reclaim control. 2. Watch choke points. Hormuz risk is not a headline. It's a pipeline into inflation expectations. If shipping disruptions broaden, it bleeds into energy prices, then into currency expectations, then into metals. 3. Watch spreads, not spot. If paper slams but physical premiums hold, paper is lying. If premiums compress because physical bids vanish, paper is winning. 4. Watch the front month. If near-term contracts stay stronger than deferred, the market is paying for immediacy. That's not speculation, that's urgency. 5. Watch the quiet indicators. Lease rates, swap stress, dealer halts, those are the canaries. Now, I want you to notice something about this entire story. The war did not create the metal problem. It revealed it. The metal market was already running hot. Open interest was already collapsing while price rose. Physical premiums were already persistent. And then the world handed the market a reason to stop pretending. This is why the next move could be violent. Because the system hates repricing slowly. It prefers denial, until denial becomes expensive. And once repricing begins, it rarely stops at fair. It overshoots, it panics, it squeezes, it hunts. So let's talk about what a Sunday night open can look like. Scenario 1. Gap up, hold. Futures open closer to where overnight rails traded. Short scramble. The narrative flips from pullback to breakout. Media runs late, retail chases, physical stays firm, premiums remain sticky. Scenario 2. Gap up, slam down. Banks hit paper immediately to send a message. They try to paint a reversal candle. They want you to believe the event is priced in. They want you to think the premium is temporary. If physical holds firm anyway, that slam becomes a gift and a confession. Scenario 3. Disorderly trading. Volatility is so high that dealers widen spreads or pause, like the Thailand example. Liquidity evaporates. That's when you learn the difference between a market and a quote. Which scenario are we in? We don't know yet, but we know what to watch. Now I'm going to give you the 2 questions that matter, and I want you to answer them in the comments because your answers will tell everyone watching how you're thinking. First question, do you trust the paper price more or the physical premium more, and why? Second question, in a real escalation, do you expect capital to run to liquidity first or to safety first? Drop your answers below, I read them, and the best ones get pinned because the comment section is where we see what the crowd still doesn't understand. Now, one more uncomfortable truth. A lot of people only look at metals when they're already scared. They wait for confirmation. They wait for a headline that gives them permission. And by the time they buy, the move is already halfway done. That's how markets steal from the cautious. The informed money doesn't wait for certainty. It waits for asymmetry. It waits for the moment when the downside is known and the upside is unpriced. The script framed that idea through classic trading wisdom. The best operators position before the crowd recognizes the shift. This weekend is a live example. If you waited for official confirmation, you woke up to it. and the price already moved on the rails that don't sleep. So what now? Now you get disciplined. You stop doom scrolling. You stop watching 1-minute candles. You stop letting volatility rent space in your head. You watch the structural signals and you act like a professional. Because the next trick will be psychological. They will try to make you dizzy. A $3 drop in silver does not unstrike a target. A red candle does not reopen an airspace. A margin call does not refill a vault. Volatility is the costume. The shortage is the actor. And in this story, the actor has the script. Now let's bring it back to the claim inside the script. Silver near $95, tokenized gold near $5,600, physical China gold around $5,560 with a big premium, and physical paper gaps widening. Whether every number holds by Monday is not the point. The point is what these numbers represent. A market that is repricing risk and repricing trust. That's why this isn't background noise. Because when the world reprices trust, the move doesn't end in one session. It changes behavior. It changes allocation. It changes policy. And it changes what people will accept as settlement when the next shock hits. So here's my warning and my promise. Warning. The next 72 hours will be emotionally loud. You'll see sensational headlines. You'll see wild candles. You'll see people screaming top and collapse in the same hour. Promise. The signal will still be there if you know where to look. Look at premiums. Look at lease rates. Look at front-month strength. Look at dealer behavior. Look at shipping risk. Look at duration. And remember this. When physical and paper diverge, the chart is not the truth. It's the argument. Physical is the verdict. And don't ignore oil. Metals are reacting, but oil is the fuse that can turn a military story into an inflation story. When even a handful of cargoes hesitate near Hormuz, insurance costs jump, routing changes, delivery times stretch, and every importer starts bidding like they're the last buyer on Earth. That feeds straight into currencies, then into rates, then into the real yields math everyone pretends is boring. In a hot war environment, that math stops being academic. It becomes household pain. This is why the next headline that matters might not be another strike. It might be a shipping suspension. It might be a refinery reroute. It might be a single sentence about extended operations. Because the moment the market believes duration is real, it stops trading this like a spike and starts trading it like a new regime. So keep your eyes on the one metric that never lies. The premium people pay to get out of promises and into possession. One last thing before you go. If you want me to keep breaking these events down in real time, without filters, without fluff, hit subscribe. Short and simple. Subscribe so you don't miss the open. Because the moment futures reopen, we're going to learn something priceless. Whether the paper market is still in control, or whether physical just sees the wheel. And if physical sees the wheel, the next move isn't a rally. It's a re-rating. And re-ratings don't ask for permission.